Hi, James Good here with an On the Money market update for Monday the 26th of November 2012. Today I want to update on the three peaks and a domed house pattern which is reaching a critical stage, and I want to see if it might be possible to resolve this extremely bearish outlook with the more bullish outlook in many of my recent technical studies. Here is the pattern in SPY, the proxy for the S&P 500. At the last update we had three remaining possibilities. My preferred labeling is in red, in which we're due one more high before the stock market peaks, one in yellow in which the market already topped here on September the 14th, and the other possibility that the pattern is bust. Because of the depth of this correction, which is even more marked on the other US stock indices, I've had to conclude reluctantly that the red scenario is virtually dead. None of the previous historical examples back to 1923 had such a deep retracement just before a peak. So that leaves us with only one way the three peaks can play out. But that labeling of the pattern shows up perfectly not on the S&P, but on the NASDAQ 100. Here, point 23 was on September the 21st, within spitting distance of the date I projected back in June. So if that's correct, we can label this as point 24. Point 25 completes the dome structure, and we probably just hit point 26, which is essentially the bottom of the first wave down. There would then be two more major stops left to complete the pattern. Point 27, somewhere between 26 and the top, and the minimum target, point 28, which is always at the level of point 10. And here, in this case, in the NASDAQ, it's at 2035, 29.3% below the top. In SPY, the equivalent is at the last year's October lows, here at 105.18, 28.6% below the top. So if you want to go short here, which would represent pretty good risk to reward, or even if you just want to hedge or lighten up on your other investments, where might the reversal point actually be? Well, I looked back through my charts of the Dow at every major bull market top and every top associated with the three peaks pattern since 1929. Now there were 20 bear markets or corrections of 20% or greater in which the Dow broke down through its 200-day moving average, then reversed and closed back above the average as it did last Friday. So how high did they manage to get? Of those 20, 17 retraced at the very least 56% of the decline before rolling over to new lows. Of those 17, 13 exceeded the 61.8 retracement level, with 6 retracing 78.6 or more percent of the entire move. So if we are heading into a new bear market, and assuming historical precedents will apply here, we're looking at roughly an 85% probability we'll see at least 13,138 on the Dow before rolling over, 65% probability of seeing 13,207, and a 30% chance of making it to all the way up to 13,381. However, that does not take into account the possibility that the pattern is bust and that we're actually heading for new highs. So those percentage probabilities are actually even greater. Rashly apply those same retracements to the S&P 500, you get equivalent levels of 1416.8, 1424, and 1446.4. And interestingly, as I showed on Friday, the S&P has just formed an inverse head and shoulders with a target of 1445. Equivalents on the NASDAQ, 2709, 2731, and 2796 respectively. Finally, I'm beginning to see one scenario in which this pattern and the many bullish studies I've seen for the S&P could be reconciled. Here's how. The NASDAQ 100, and folks that means Apple, has formed a major top and is now in a bear market which will take it down a minimum of 29%. But although it won't make a new high, the S&P and the Dow will show greater relative strength and bust their three peaks patterns and make slight new bull market highs in 2013 on weaker internals. That's when the bear market will truly